To remain updated with the latest business news, click on the bell icon.
Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Abha Bakaya and our guest today on the show, Samit Vartak of SageOne Capital. Samit is a good old-fashioned mid-cap and small-cap stock picker. Over the years, he's had top of the line returns from the mid-cap and small-cap funds that he runs very successfully. And he's here to tell us whether it's all okay in the mid-cap world. Samit, it's a pleasure having you on the show today. Tell us, how are you feeling about mid-caps and small-caps today? Because we've had a great run-up. People have made a lot of money in the last 1 year. But now there are concerns with all that is happening in the environment, whether stocks have run ahead of themselves. Are you feeling comfortable with valuations in the universe that you handle?
Right. No, you're right, Udayan. It's the valuations, at least in terms of the most common parameters that we follow, P multiple are high for sure. There is no question about it. But, I have presented some analysis in my newsletter where I think there are a few parameters which I think are much more comforting. Few of those are, if you look at the price to book ratio, it's still at around 3.6, whether you look at the large cap or the small cap, mid caps, which is near the average of the market over the last 30 years, or if you look at last 40 years. And generally, whenever, price to book is a more relevant metric because it is much less volatile in nature, and it has much higher predictive power over the next, in the long run, whether it's a 5 to 10 years, it's much more correlated. So if you look at 10-year return, it's almost the R square, what you call, the correlation is almost 75%, which is pretty decent, right? But in the short run, the P multiple or price to book is just a random noise. There is no correlation at all. So just because the markets have gone up in the last year and a half, doesn't mean that it's not going to continue going up, because just looking at the statistics, there is nothing to prove any of that. What gives me comfort is also that if you look at the cash flow generation, it is at the highest level that we have seen. Generally at the peak of the market, the cash flow drops. The cash flow from operations typically goes down because the receivables increase, the credit cycle or the credit terms that a company provides to the customer also, goes up and it's loose, which is not the case right now. So the debt to equity ratio, typically the debt to equity ratio also goes up because there is a huge, capex boom that happens towards the end of any economic cycle, which is today at the lowest level that we have seen in the last 30-40 years, right? So when you look at the fundamentals of the economy, they seem more towards the bottom of the cycle. But yes, there is a huge divergence between the valuation seems to be more towards the top of the cycle. But again, as I said, when you look at the price to book or whether it's enterprise value to cash flow from operations ratio, they're more towards the average. And that's where I think, I'm comfortable, which wasn't the case in 2017. The price to book, whether it's in 2011 or 2007, the price to book you would see had gone up significantly higher. Even in the early 1990s, 1990 to 1993, the price to book had gone to 10 times. In 2007, the price to book was about six times. Today, it's at 3.6 times, which is reasonable enough.
Right. So what's the right way to play it from here on, Samit? I mean, that's the big question. Because a lot of people are drawing parallels with this cycle which is playing out to 2003 to 2007. Do you see it that way? Because then the right way to play it would be to play the big capex plays, to play the big corporate banks because of a new credit cycle unfolding. Or do you think this one is different and one should not get trapped into thinking it's the 2003, 2007 story playing again?
Right. No, you're exactly right. I think 2002, 2003 was the bottom of the economic cycle, and a lot of ratios seem similar to that. But the valuations in 2002, 2003 were probably 1/3 of what we see today. So that's a big difference. There are a lot of the growth is already priced into the markets. And then again, 2003, 2007 was sort of a once in a century kind of a boom cycle, where all cylinders were firing across, whether it was China going for a huge capex boom across the world. There were capex housing cycle which had picked up. Same thing was in India. India went through a huge infrastructure boom. real estate boom and a big capex cycle where the financial sort of lending policies were pretty loose and they continued. Today I think betting on similar things repeating, because we all know how sort of leveraged China is, and China doing the same as what they did in that period it seems extremely unlikely. Same thing is with the world. The world is laden with a huge debt, which wasn't the case in 2002 2003. And India seems to be in a different position because India's leverage, even debt to equity at a GDP level, is pretty reasonable. The corporate debt to equity is below 30% of GDP, which generally used to be 70-80%. China, at the same level would be at 200%. So there is a huge difference. So India, I feel, has a much higher potential of repeating that cycle, just because of the kind of cash flow that the companies are sitting on, as well as the debt to equity ratio that the company has. So there is a lot of room for them to, the median debt to equity is 0.16 times. So there is a room from going from 0.16 times to their normal level of 0.7, 0.8 times, right? But the same kind of sectors playing out will be very difficult. For example, lending space, the banking space, when the companies themselves have deleveraged, going through pretty rough period last 5 years, they are generating enough cash so that they can do the expansions through internal accruals. So the same ratio that we typically use for lending growth or credit growth of 1.5x or 2x of GDP, it's extremely difficult. I mean, they would be definitely underperforming, over the next cycle. Same thing is with the more cyclical sectors like auto. So you have to be very, very careful, because you will not have the other wheels like the global wheel or the Chinese wheel to pull up the economy as what it did in that kind of a cycle. So I think this time you have to be very, very selective, just given that the valuations of 3x of what they were in 2002, 2003. There could be a risk if something doesn't play out. You could face a big downside. So you have to bet on sectors where the visibility is extremely high, and irrespective of whether the economic cycle picks up or whether we go through a struggling economy, those sectors should be able to deliver. I think the
Okay.
probability of success where you invest has to be much higher today, rather than just betting on a macro saying that the economy is going to go through a big upcycle. I think that's a very, very risky game.
So let me ask you about one of those sectors. You mentioned housing in passing, and there is a general feeling that after a long time there is an upcycle in real estate. Now, I saw your portfolios, and you seem to have representation from real estate, from housing finance, and from house building materials. But I want to ask you whether you really think that a real estate cycle is playing out, and what is the right way to tap that opportunity?
Right. So see, now again, there's building materials which are utilized across different segments, and the drivers for which could be from housing, it could be from factory construction, it could be from airport infrastructure, warehousing kind of a construction. So I am betting, I don't want to rely on just housing picking, even though I'm really, really positive that housing is going to pick up. But the building material is something which will be driven by a lot of infrastructure as well as the capex spending on the factory corporate side. Because if you see the environmental clearances today, the applications are at all-time high. They have tripled in the last 3 years. And that has been driven by, one was, of course, the manufacturing tax rate incentive that companies have of 15%, and which expires in March 2023. Hopefully, it will be extended because of COVID. So there is a reason for that. There are PLI schemes, where you see that the pace of approvals for PLI schemes is catching up. So there will be spending. Put up those extra expansions in various industries, whether it's the food or defense and electronics and white goods, across the space. And then government's finances are pretty decent enough. And no one expected their finances to be that strong coming out of COVID. So I want to bet on building materials which just do not depend on one sector, because there is no guarantee that real estate is going to pick up. Of course, things are aligned. The affordability of housing is very low. The prices haven't gone anywhere in the last 10 years. And at the same time, you see that the cost of building a house has gone up. So there are a lot of reasons for housing to pick up. But again, as I said, one has to be very, very careful when you bet on stocks. You can talk a lot of entertaining commentary based on macro, but what you do at a stock level has to completely depend on that company, that promoter, and the probability of that company succeeding has to be very high. So even if you're investing, say, in a real estate segment, it has to be a specific location, because real estate is all about location. So there have to be opportunities, in that specific company, where you see that irrespective of whether the real estate cycle, fails, that company should do decently well. The chances of you losing money is low.
Okay. Samit, while what you're saying makes an incredible amount of sense, of course, given the number of retail investors jumping headlong into this market and the kind of euphoria we've seen over the last year or so, the fear is that should there be any kind of knock, it will be the broader markets that get hit the worst. How would one really convince a retail investor of the right strategy at this time, or suggest to them an appropriate strategy in terms of really finding some of these gems in the market that you're talking about?
Right. I think, yes, Abha, I think the most common question that I get asked today, by most investors is this the right time to come into the market, right? So, I mean, first is the decision to be made there. I want to put up statistics which hopefully help. If you look at the market over the last 40 years or 30 years or 25 years, on a daily basis, the probability of you making losses is almost 47%.
Wow.
So 50 to 53% of the days are positive in the market. Once you move that to a monthly level, the probability of your failure drops to 26%.
Okay.
From that monthly level, once you go to the annual level, the probability, actually the monthly level, the probability is still 43%. At the annual level, the probability of your failure drops to 26%.
Got it.
Once that 1 year goes to 5 years, the probability of you making loss is 8%. And at 10 years, there is, at least in our India's history, there hasn't been a 10-year period when investors have made a loss. So when you are coming at such valuations, the investors have to be clear on what is their time horizon, and what is their readiness to bear losses. Because even in a 1 year period, there have been periods when the 1 year losses have been 65%, especially in the broader market. It has been as high as 75-80%, right? So are you ready for that? So even though on an annual basis, your probability of success is 74%, if that 26% plays out and the worst case kind of a scenario plays out, if the market goes down by 80%, are you ready for that? Right? So that's a big question. And see, most of the retailers typically find it difficult to beat the market at a overall level. And if you are giving your money to the fund manager, these are the questions that you need to ask. Is at what period, like when you look at the market, when you go to 7-8 years, there is a 0% probability, at least looking at the history of last 40 years, that you will make losses. At a fund manager level, you need to look at what period does that probability drops to zero. So you need to find a fund manager where that period is maybe 3 to 4 years. And then you need to come in with that kind of a time period. That's, I think, one of the most important thing that investor needs to come in into the market with. And then, when you ask, in company level analysis is extremely difficult. it takes a lot of time, because it's not just understanding the financials of the company. Investment, according to me, is a lot more understanding the businesses. People just look at the numbers, financials, look at last 10 years, they would read through, maybe some basics about the annual reports, and look at the P multiples and try to do, investing based on that. For me, the biggest multi-baggers have been where you really understand the business, because without understanding the business, understanding the growth prospects of that company, or understanding the valuation, is useless. You cannot do valuation as well as, the estimation of the growth without understanding the business. And understanding the business takes multiple years. You have to look at different industries, not just in India, globally, in nature. And that's where you will reduce your probability of making losses. So the more you understand the businesses, the more you reduce the probability of you losing businesses. And that's what we try to do. Is that if you look at our last 10 years, our historical returns probably are near 30%, but more than 50% of the companies have delivered that kind of returns. So it's not concentrated. That means the probability of your company going wrong or making losses is very low. And for us, the number of companies which have made losses is just 12%. And with that losses, typically then your sort of horizon, where even if you come in at the worst point in the market, which is the peak of the market, how long does it take for you to recover your money, even if you go through a big loss? That's a very important question that one needs to ask. And then you need to see, are you able to take that risk?
So, talking of businesses, Samit, let me ask you about one which is a happy hunting ground for most mid-cap stock pickers and small-cap stock pickers, which is chemicals, whether specialty or general chemicals. You also have a fair share of your stocks or picks from this chemical space. But which parts of the chemicals universe are you most optimistic on as you look at the next 2-3 years?
See, chemicals is a space which has been a structural sort of story for the last 10 years or so. So, we started investing in 2011-12. And then the valuations of a lot of these chemical companies were maybe in low teens, and their growth rate was, 25-30%. Today, the growth rate probably, some companies do still have such growth rate. But the valuations are 45-50, so it's almost 3 to 4x of valuation that you are paying. So one needs to be very careful, because, investing is not just about going for things which are in flavor. Most of the time, if everyone believes that this is a sector which is going to do great, you don't end up making money in there, because, it's already priced in. And I think there is a huge risk in the chemical space today, because in the last couple of years, there have been a lot of disruptions, especially in China, because of, the government forced shutdowns of plants. There has been increase in freight costs. So there is a lot of logistical issues, and there are, certain frictions in the supply chain, because of which the prices of certain chemicals have gone up. And that has resulted in huge profitability of some chemical companies, which may not be specialty chemicals. So they're making, as much money as what a specialty chemical company is making. And they're commanding those kind of valuations. Whereas in reality, their valuations probably should be in, low single digit or low teens kind of valuation. So that's where the risk is. So if you are getting into the specialty chemical space, one has to be very careful that the profitability over the last year and a half is something which is sustainable. It's not just purely because of luck. It is because of the things that the management did, that they are getting into the right chemical space where the competitive advantages of that company are high, even if you have to compare them with the Chinese companies. So today, the spaces that I see that happening, I think the lowest hanging fruit is in companies where they are import substitutes. Because typically, if you are importing a chemical from, whether it's from China or any of the other cheap geographies, the cost of bringing in the chemical, storage, working capital is typically 15 to 20% at least. So if you are just substituting that, you have that advantage. So they're maintaining the profit because 15-20% cost advantage is huge in a chemical space. So I would go for that. Import substitute something which is lower in risk because of some these disruptions going away. Second would be companies who have executed on the API and intermediates space. If you look at the chemical chain, there are basic chemicals, then there are intermediates, and then there are the APIs. APIs are the main, basically, ingredient for medicine, and there are formulations. So India is not at all present much in the basic chemicals. India's advantage is where there is a lot of R&D and research required. And API and intermediates are the space where you heard a lot about them, but there are only 2 or 3 companies who have successfully been able to execute. A lot of them were concentrated in, 1 or 2 therapeutic sort of drug categories, but a few of them are becoming a little more global in nature. They are showing that their execution has been successful beyond just 1 or 2 categories. So I think that is another space where I'm really positive on. And again, you have to be careful about valuation in this space. This is not a consumer product where you can know the sustainability of these for next 15 years or 20 years. And valuation is all about the duration of growth. Here, you never know. You have to take it, 2-3 years at a point in time. And for such companies, paying beyond 40-45 times is really risky, and that's what I think a lot of companies are trading at today.
Samit, we are unfortunately out of time, but great hearing your thoughts today, and thank you very much for your time. Wish you all the best.
My pleasure. Thank you so much.
If you like the video, do like, comment, share and subscribe.